Hi, so I'm Professor Acharya from New York University Stern School of Business. I do research in finance, mostly in banking, financial stability, central banking. But over the past 5 years, I've also started doing work in climate finance with the intention of trying to understand how would we do a good climate stress test, for example. Basel III is basically a set of requirements that regulators have imposed on the largest banks globally. Uh, United States sort of moved along with a part of the reforms in the last 10 years, but did not accept all of the Basel III reforms that were to be adopted. So the rest of the world has moved a little bit further ahead. And so my way of thinking about Basel III implementation is really bringing the US banks, the largest US banks, in line with the rules that have been required of the largest banks globally. There'll be slightly higher capital requirements, slightly greater sensitivity of how banks have to put aside equity capital for what kind of risk. So there'll be slightly greater risk sensitivity, etc. But in a nutshell, it's going to require that banks have a little bit more, largest banks have a little bit more skin in the game when they are undertaking risks. Now, why is it on TV? It's because you can imagine that largest banks in the US don't want this. It's going to increase to some extent their private cost of capital. I don't think from a society standpoint we should really care as much that they have more skin in the game. It is perhaps not a bad thing. And so there's resistance to it, and so they, I think, are lobbying hard against not wanting these reforms to be put in place. It might have some political implications as well in terms of how the financial sector goes at the November elections in the United States. And unsurprisingly, they have found a way to perhaps make it to the televisions as well. But I'll be happy to talk more about what I think might be some additional gaps that perhaps the US reforms still need to worry about. So in some sense, if the rules have been adopted by largest banks in Europe, but the US banks have not adopted, on certain risk margins that gives them an advantage. Now, in a way, therefore, as I said, Basel III is a bit of a level playing field between the largest banks of the US and Europe. Typically, these rules do alter bank business models. The financial sector is always organically evolving to the sort of changes which are imposed on them. They're always trying to figure out, can I repackage the risk to some other part of the financial sector? Maybe it's non-bank financial institutions. Sometimes banks will originate the loans, but then send them out into the non-bank financial institutions because it's cheaper in terms of regulations to warehouse the risks on balance sheets of non-banks. They might even entirely get out of certain types of origination activities altogether. If there is an overall increase in the private cost of capital for banks, they may pass it on to loans and so on. And in a way, this is really therefore like a trade-off as I see it, which is that increasing the cost of capital for banks is not for free. But we have seen that when banks are not stable, they can impose a very large cost on the financial system. But my view is simple, that essentially you do want to keep a level playing field. These are rules that were agreed upon, and it's an open question whether the level of Basel III requirements is right or not. But the way I see it is that banks that have been subject to good capital requirements over the last 10, 15 years, they have done better. The United States did have a banking stress in March of 2023 with the collapse of Silicon Valley Bank, but the large banks did fine. And to me, this is sort of a proof that even when the rest of the system in the US was facing contagion from the failure of Silicon Valley Bank, the largest banks, which were subject to stricter rules, not yet Basel III, but stricter rules than other banks in the US, they actually fared quite well. If anything, depositors were flying into these banks as safe havens. They benefited from a flight to quality. So that's sort of the paradox. In my view, the largest banks have just benefited from being more stable. So for them to resist a further strengthening of the rules, and on the margin it's not that high, you can see that this is mostly lobbying and political. I think there are three big gaps in my view beyond Basel III. One is that we saw that banks can fail because of interest rate risk. So Silicon Valley Bank had a large stock of uninsured deposits, which are very short term, being rolled over at each instant or certainly every night. And they invested a lot of these deposits that flew into their balance sheet into long term treasuries and mortgage backed securities. When interest rates rose in the United States, even though not all of the assets got marked to market, at least from the investors' eyes, there were losses. And at some point, questions were being asked whether Silicon Valley Bank has assets that are worth enough to repay all the liability holders, notably its uninsured depositors. And then there was a run on the bank. There were large deposit outflows on several other banks. In fact, 3 other banks failed at that same time. So why did this happen in the United States and not elsewhere because of rising interest rates is because US has not set any regulatory standards for how banks should have skin in the game for taking on interest rate risk. So Basel requirements don't actually stipulate how exactly interest rate risk should be regulated in a standardized manner, and in the United States they have left it to the risk management departments of banks. The irony is that it's left to the banks because it's supposed to be very easy to do, but as we saw that many risk management departments didn't actually do a very good job of that. So first thing I would say, the big gap in the United States with Basel III is that they need to fix interest rate risk management at banks, put some minimum standards so that something like Silicon Valley Bank situation doesn't arise again. The second gap in my view is that US has imposed some of the liquidity requirements. This fact that when you have deposits, they are likely to run. So should you have more liquid assets so that you can pay them off in a timely manner? The requirements of this type are mainly imposed on the largest banks in the United States. But what we saw in case of Silicon Valley Bank and the contagion that followed is that even small banks can be systemic as a herd. They can all collectively fail, and it's almost the same as a large bank failing. So the exception that the United States has made in not applying the rules to the largest banks, to the smallest banks, I think it seems that it has been borne out now in data that this is not a good idea. So I think US may want to consider imposing liquidity requirements in a uniform manner across the banking system. And very quickly, the third big important gap is that we were just discussing that when rules like capital requirements get imposed, the banking sector is organically evolving. It's figuring out what risks to retain and what risks to push off towards the non-bank financial institutions. I think the non-bank financial institutions and their intermediation in the US is now actually growing at a faster pace than the banking system. So it could very well be that we are regulating the banks, but the real risks have actually migrated and shifted over, perhaps repackaged, transformed into different versions, and they are sitting in the non-banks. In my work, what I find is that it's not just that. In fact, non-banks are constantly dependent on banks for liquidity, for financing, for credit lines, and so on. So it's not even that risks have just moved. They could spill back to the banking system through the fact that banks and non-banks are actually quite intimately connected. So I think going beyond Basel III, going beyond small banks, going beyond interest rate risk management is this big elephant in the room, which is that is there now a big part of the financial system that we should be concerned about from a financial stability standpoint, which we are just not monitoring, supervising, regulating.